Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Good morning, everyone. Just about 10 o'clock on Monday, the 18th of May. I just got back to my home office. I went out this morning and voted, and it's election day here in Pennsylvania, primary election day. And I stood outside of the polls for a couple hours from 7 o'clock to 9 o'clock to help the fellow who's hoping to replace me on the school board. So as many of you know, I've served on the Council Rock School Board of Directors for coming up on 8 years. It's 2 terms. I think that's enough for anybody. And I'm not running again. So there's a really great individual who stepped up to take that position. And I gave him a couple hours of, campaigning for him this morning at the polling place. So hopefully he's successful, and we continue moving forward. So I want to welcome everybody again. Good morning. Another beautiful day. Every Tuesday, I say, it seems like a beautiful day. So let's be thankful about that. It's been a crazy time in the markets. I actually don't, because I just sat down, I don't have my my ticker up. Let me just see what's going on out there today. And the Dow is down again today. We've been talking about volatility, and we're certainly seeing the volatility in the markets, and we can expect more of that for the remainder of the year. So don't be surprised. Anticipate it, plan for it, and make small changes as you need, but make sure your foundation is set. So again, it's Tuesday, May 18th. I just want to remind you that everyone is muted. There is Q&A at the bottom of the screen. Chat is disabled, and these meetings are recorded. We have some upcoming webinars. Again, we've just been having some scheduling issues. I've got some travel to do. I have to travel for business to go down to Austin, Texas in a few weeks. But we do have 4 special webinars that are being planned. That's funding using annuities and retirement planning and Roth conversions, fiduciary assistance for powers of attorney, trustees, executors, investment fundamentals, and the reality of the 4% rule. So today, just like normally on our Tuesday morning webinars, I'm going to talk about the markets a bit. I'm going to give you some a breakdown of some of the analyst reports that I'm reading, and from our planning perspective, we do markets, and then we do a little bit of planning. I'm going to talk about inherited IRAs. So I've had a couple questions this week, and unfortunately, I had a conversation with a client yesterday who just lost his mother, and it had to do with inherited IRAs. So I thought it would be a good conversation to have. I went back and looked at my notes. It looks like we haven't talked about it for a little while. So it's again, a good conversation to have. There is some question now about the Secure Act. If you remember, required minimum distributions were, stretch IRAs were essentially killed by the Secure Act. So now you're required to take distributions by the end of 10 years in most circumstances. So there is some question. The IRS sent out a memo that implied that you're required to take a distribution each year during those 10 years, but that doesn't seem to be the intent of the rule. So we're waiting on some clarification for that. I did email my slot group early this morning at about 4 o'clock this morning, and I have not heard back. I can't fault them for that, just to see if there's any further clarification on that, but I haven't heard of any. So we're going to talk about inherited IRAs, what you do when you inherit an IRA, and the best way to manage that. So let's jump into it. And speaking of slot, I want to go through some of the emails I read throughout the week that I thought were interesting. And this first one, I think actually both of them I put in here, have to do with beneficiaries and IRAs. So I'll just read to you the first one. And it was a question sent to Ian Berger, who is one of the support people, the analysts with with Ed Slott's group. And the question is, good afternoon. We have a client who is 19 years younger than her spouse. So a lot of these questions come in from CPAs, attorneys, financial advisors, and the Ed Slott group responds. So again, they write, good afternoon. We have a client who is 19 years younger than her spouse. He passed away this year. We are planning to keep this as an inherited IRA for now. Can we move the assets to her own IRA at any time? So that was written by Julie. The answer is Julie. Yes, a surviving spouse can roll over the deceased spouse's IRA to her own IRA at any time after death. Often younger spouses delay doing a spousal rollover until they reach age 59 and a half. That's because as long as the IRA remains an inherited IRA, the surviving spouse can take a distribution from it before 59 and a half without the 10% early distribution penalty. So that's a really good point and something people miss. And let me say this, and I'm not sure if he's on the webinar today, and if he is, I'm sure he wouldn't mind me sharing. But the conversation that came from this particular client was, I'm inheriting this IRA from my mother, and Merrill Lynch has me set up for a distribution within the next few weeks. So a distribution means he receives the money as payment, whether it goes to an account in just his name, a non-IRA account, or they send him a check. This happens all the time, by the way, because they just want to get through the expediency of getting it done. And the person on the other phone line of the other end of the phone may not be knowledgeable about it. But I tell you, I've even had attorneys. I had an attorney famously one time call me about the fiduciary assistance work that I do. And she said, I want your help in settling this estate, but don't worry. I've taken the first steps. I put all the money into an estate account. And I said, well, where did the accounts come from? And she said, well, most of them came from IRAs. So right there is a big problem. The money transfers from IRAs to an estate account. Well, now you can't undo that. You can't, once it's in an estate account, there's no opportunity. Back then we had stretch IRAs. There's no opportunity for that to be distributed. And in fact, it all is now distributed in 1 year. And this was about $3 million. So that's a lot of unnecessary tax. Now your beneficiaries may want to take that money out all in 1 year, and they can take it out right away, but it's about allowing for options. So the first thing that you should do if you're a beneficiary of an IRA, whether it's your spouse or a non-spouse, don't do anything. Just don't do anything. Have a conversation with us. Make sure it's a qualified individual you're talking to. Again, I see these emails all the time from advisors around the country who should just know better, in my opinion, because they should go through the training education, go through the constant updates for these really important situations. Almost all of my clients are baby boomers, and it is, IRA distribution planning, you're inheriting IRAs. It's part of what's happening. So you better be knowledgeable about these things. So off of my soapbox. So in this case, think about this. So they said, well, here's a spouse. So a spouse can treat an IRA as his or her own. So a spouse is beneficiary. Let's just say my wife, God forbid I pass away, my wife is the beneficiary of my IRA. She might want to do exactly this. She might want to move it to an inherited IRA because my wife's only 54 years old. And if she needed access to those funds, she could take them. She would have to pay tax on them, of course, but she wouldn't pay a 10% early penalty, right? Because she's before 59 and a half. Now, that's if she has it set up as an inherited IRA. What if she doesn't have it set up as an inherited IRA and she just listens to somebody who doesn't really know what they're talking about, and they just roll it into an IRA on her own, and suddenly she needs money? Well, she would pay it. And if she took that out prior to 59 and a half, she would pay a 10% excise on that over what her tax rate is. So this is a really good point. Ian appropriately advises Julie that yes, a surviving spouse can roll over a deceased spouse's IRA to her own IRA at any time after death. Often younger surviving spouses doing a spousal rollover, they delay doing a spousal rollover until they reach age 59 and a half for all those reasons that we talked about. If my wife then turned 59 and a half, then she could move that money to a a traditional IRA in her name, not an inherited IRA. She could do that at any time under the current rules. And we're kind of switching here because now I am talking about the planning of inherited IRAs, and that's what I intended to talk about in the second part. But just for today, I'm going to switch around a little bit because here we are, we're talking about it. So why might my wife, if she inherits my IRA today, why might at age 59 and a half, why might she want to move it into an IRA just in her name, like it's her own, which a spouse can do? A non-spouse cannot do that, but a spouse can do that. Well, the reason she might want to do that is because an inherited IRA cannot be converted to a Roth IRA. And if you know me, if you heard me speak, if you're a client of mine, you know that I think one of the most valuable tools we have are Roth IRAs, either via contribution or conversion. And we talked about that over the past couple of weeks. So at 59 and a half, she might say, okay, I want to convert this into a Roth IRA. Let me move it to an IRA that's my own. Now, listen, she may want to do that ahead of time. She might want to do it at 54 if she's got enough funds available that there's no chance that she's going to have to access those IRAs. You don't know any of that without looking at the entire picture. That's why I tell you, first, do nothing. First, do nothing. If God forbid the worst happens, you lose your spouse, you lose your mother, you lose someone you've inherited an IRA. First, do nothing. Call us. Let's go over all the facts before you make a withdrawal, get a distribution, whatever it is, because those things cannot be done. I could hear the little bit of panic in that attorney's voice when I told her, well, now that you've moved all that money into an estate account, we can't do a stretch IRA. So everybody's going to have to pay tax on that money in this year, and for this tax year. And she said, well, can't, that's what Fidelity suggested I do. Can't I just call back and undo it and put it back in the IRA? And the answer is no, you can't. You can't undo that. You can't put the milk back in the bottle, so to speak. So it's really, really important that you take very careful steps when you're involved in that. All right. The next question also has to do with the inherited IRA. And this reads, I was in your workshop in February, and I just now have an issue. I want a clarification. His client, Vince, passed away in 2008. His daughter inherited the IRA and is stretching it over her single life expectancy. So she inherited this IRA back in 2008 before the rules changed in 2020. Now, remember, I used to stand up in front of the classes and to say, we have something today called a stretch IRA that's going to disappear at some point. Well, it disappeared in 2020. Actually, the end of 2019, I believe it was. It disappeared, gone. And now we have a different rule under the Secure Act, but no more stretch IRAs, nothing past 10 years, except in limited circumstances, and we'll talk about what they are. His daughter inherited the IRA and is stretching it over her lifetime. If she passes away in May of 2020, she passed away in May of 2020, is her husband now the daughter's beneficiary? She's the beneficiary of a stretch IRA. Is he eligible as an eligible designated beneficiary to continue the stretch using his wife's remaining life expectancy? What do you think the answer is to that? The answer is no, because he's not an eligible designated beneficiary. So, and she died after 2019. That's when the Secure Act came. If she died prior to 2019, then it would be okay. So he has to use the 10-year rule. Now, let me just fast forward to the bottom of my notes here so I don't miss anybody. And I'll tell you who the eligible beneficiaries are. Eligible designated beneficiaries are surviving spouses, minor children of the account owner, disabled individuals, so minor children of the account owner. That's important. People get hung up on that sometimes. The children of the account owner, minor children of the account owner, disabled individuals, the chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So that last part, the beneficiary is not more than 10 years younger than the IRA owner, can be a little confusing, because that in fact means that if your beneficiary is older than you, then they could be an eligible designated beneficiary. This is where it gets kind of confusing. So that's again why you just have to hit the pause button and get all the facts, and then make an educated decision. Okay, back to the mailbag. Okay, so they're the two. They're the two questions. Yeah. Okay. Good. So let me jump into investments, and I'll come back to inherited IRAs and talk about what they are and with some more detail. Let me just pause to see if there's any questions because I do not see my screen up. Okay. Very good. I'm just going to move this over here so I can see you folks. If you do, again, when you see me looking around, I'm looking at just multiple screens so I can keep everything going. So last week, or maybe earlier this week, last Thursday, the Bureau of Labor Statistics, so you hear me refer to this group often, they release the Consumer Price Index reports, and that's where we're talking about inflation. There's been a lot of talking about inflation over the past year, just about, and now a lot of concern because we're all seeing it. So last Thursday, the BLS, the Bureau of Labor Statistics, released the Producer Price Index. So the Consumer Price Index is what we all see and what we all spend. There's different areas for the Consumer Price Index, but generally what we all hear is the CPIU, right, for urban areas. And then when we look at the Bureau of Labor Statistics website, anybody can sign up for these emails if you're so inclined to get these email updates. You'll see them for different regions, and then they give a breakdown. I shared it in one of the webinars, what that looks like, the different breakdown of different areas. Well, I looked up the definition for you on just Googled it. You can do the same thing. The CPI, Consumer Price Index, is a measure of the total value of goods and services consumers have bought over a specific period. While PPI, today we're talking about the Producer Price Index, is a measure of inflation from the perspective of producers. So the people that create the goods that we buy. So what the Bureau of Labor Statistics released on Thursday last week was the PPI, the Producer Price Index for April. And it also shows year over year. So the Producer Price Index is a family of indexes that measure the average change over time in selling prices received by domestic producers of goods and services. PPIs measure price change from the perspective of the seller. So what did the Bureau of Labor Statistics report for the PPI? Well, the demand rose 0.6% in April, seasonally adjusted. Final demand prices rose 1% in March and 0.5% in February. So just going back 0.6 in April, 1% in March, 0.5 in February. On an adjusted basis, the final demand index moved up 6.2% in the last 12 months, ended in April. 6.2%. That is a tremendous amount of inflation growth. Now, that is, again, the Producer Price Index, how close that is to the Consumer Price Index and what we're paying. Well, there's additional inflation built into there. So you've seen, and we're going to talk about this a little bit when we get to Byelich analyst report from Prudential, but there's a lot of concern about inflation out there, and that's one of the big things that are dampening down the markets, in my opinion, because folks are really concerned. I just had I have some electrical work I have to do. The electrician was here a couple weeks ago, and he said he told me it was going to cost me $1,200 to get the outlet I put in my garage, and he said, but if it would have been this time last year, it probably would have cost you $500. It's just the material. He buys the material. He's telling me he talked about it for quite a bit. He would normally buy the material when he has a job, but now he buys it when he has an opportunity to, and he stocks up a bit. So, that's a significant increase. We all have heard the horror stories about lumber and plywood, and so I just wanted to give you a taste for what we're seeing from the Bureau of Labor Statistics and the Producer Price Index. If you remove, so that's what did I say? 6.2%. If you remove food and energy and trade services, it went up 4.6%. So this is the largest advance it reads in 12-month data since they were first calculated in August 2014. Staggering, really staggering. So look out for inflation, its effect on the markets. You know, one of the worst situations we could be in is really fast rising interest rates and fast rising inflation. That would be troublesome. So how have the overall markets done? Well, over the last week, the Dow Jones Industrial Average fell 1.08% and the S&P 500 fell 1.35. So that's as of Friday, right? These numbers are always as of the close of the week prior to. All the indexes that I'm looking at were down as high as or as much as it looks like 3% and as little as 0.01, and that's a bond index. So interest rates went up a bit, bond indexes go down. It's kind of like a seesaw. Interest rates go up, bond values go down. That's why bond managers are really important in this time because they can manage the bonds in there, and it gets very, very difficult to choose those managers, and we're spending a lot of time there. I shared with you before. So interest rates went up a bit. The 10-year Treasury closed the week at 1.63 compared to 1.58 the week before. And whenever that happens, you'll see bonds, the value, the price of bonds go down. So again, just think of it like a seesaw. Just looking for, you know, if we were taught this in the Series 7 exam, but if this is the price of bonds over here, and this is interest rates, you can kind of think of it as when you push up on here, when this goes up, this value is going to go down. That's really, really a simple way of looking at it. But then we get into the time that you hold the bonds, so you have less fluctuation, the shorter period of time you hold them, as far as their maturity, or what we call duration, and that's how long they're going to kind of expire or mature, come due. But just think about that. And if we have a bunch of 30-year or longer bonds, the more that those interest rates go up, the more volatility you're going to have here. And what we've been seeing over the years is very steady, right? We've had different times of some volatility, but we've had some, decades of bullish bonds. So very good growth in bonds. And this is kind of a wake-up call here, back to normalcy, where we have stocks performing at one level, bonds performing at another level. But look at last week, stocks were down 1.08%, bonds were down 0.37%. So it didn't help, right? The bond, people think I want to put money in safe bonds, but that was down 0.37%. One index was down 0.84%. So you just have to be very, very careful of what you're investing in. Okay. No questions. Very good. All right. BlackRock. So going into the analyst reports, BlackRock is continuing to talk about inflation. Hotter inflation has materialized and market volatility is rising as the economic restart. That's one of their tag words. We have this restart that's happening in the economy. We're starting to see it. See more people out, more cars on the road, more people out at the store. We're starting to be able to shed the mask in certain circumstances. People feel more comfortable about going out. It's not such a struggle. People are going to start spending more money at restaurants, at the, just being out in general. We've booked a couple trips for the summer. We're going to be flying in July. Everybody in my family is very concerned about that, but it's just got to happen at some point. So we're going to see that economic restart and people start getting out and spending money again. And that again is going to create demand. And we have a lot of limited supply for things because we were shut down for, close to a year, certainly a solid 6 months of production being down and people being out of work. And there's still plenty of people out of work. So we've got to bring these people back, fill these positions. We've got to make it viable to work, make it reasonable to come out of the house and go back to work. So everybody's talking about inflation now. So here's our Prudential report from DeLucia. Again, he writes, the central conclusion of this report is that the outlook for the U.S. equity market varies significantly depending on time horizon. Despite obvious overvaluation, the U.S. equity market may continue to benefit from exceptionally strong earnings growth and an abundance of central bank liquidity in the very short term. So the banks have a lot of money. There's been a lot of government stimulus, just like many of us are sitting on money, and we want to spend that money. So I'm using us being consumers. So savings levels are higher. Reported last week, savings levels are the highest they've been in some time. I don't remember how long it has been, but at a very high level, and folks want to start spending that money. Banks are sitting on a lot of cash. We want them to spend that money, doing loans. We've got some problems. People are having a hard time buying cars because the dealers they don't have a lot of cars because of the chip issue, and even parts are difficult to get. I just we had to buy a new car for my wife, and we want to get different wheels for the car. And I called my person who handles that, and it's 4 to 6 weeks just to get a set of wheels and tires. So that is everything is like that. It's I've got that project in Newtown that I told you all about that's slowly moving forward. We are ready for the stonemason to come in and do his work, and I can't even get him there. There's just this incredible shortage of workers and material and all kinds of things. So we have that, and we have liquidity, and we have all those issues. And DeLucia talks about time horizon. As I've said before, you've heard the discussion about, well, the S&P 500 returned X% over this period of time. So over the last 20 years, you might say the S&P 500, and I'm not sure if this is the exact number, but you read these numbers, the S&P 500 has earned 11% a year. Well, what's important is your time period, because the last 10 years, last 20 years, it doesn't matter, right? It was good for you if you're involved in it and you've had growth. But if you're retiring today and you've got to map out the next 35 years, that's your time, right? So all these numbers that you hear, and people put together these slides to sell a product or sell a certain fund, and everybody does it. Vanguard does it, Fidelity does it, T. Rowe Price does it, TIAA Craft does it, everybody. But they don't focus on your time. They look at the best time that they had, or just a certain block of time. But that doesn't matter to you, not necessarily. It gives you some idea of how the fund or the investment has performed over a period of time, but you got to focus on what your time horizon is and what your time need is. And that's why that segmented investing, account segmentation, I call it account segmentation. David McKnight calls it time segmented investing. Just compartmentalizing certain investments for different times in your life is very, very valuable. Because does it really matter to you what the S&P 500 did from 2001 to 2021? Not anymore. And it doesn't necessarily mean how it's going to perform for when you retire. Some of you are going to retire today. Some of you are going to retire next month or next year, and it's different for everybody. I hope that all makes sense. So time horizon is very, very important. I'm just looking and reading through here. There's a lot of talk here about earnings estimates and inflation again. And he talks about inflation. Inflation and the future trend in productivity are the critical variables in outlook for healthy and sustained economic growth and corporate profitability. It's very, very likely 2021 is going to continue to be a good economic environment, and 2022 maybe too, because we have all this pent up money to spend, and perhaps the things not being available, building supplies, autos, let's hope it doesn't really get down to food. Food's getting more expensive, but it's still available from what I see. But it's certainly getting more expensive. So let's hope that doesn't change where it's not available. But maybe this is dampening things enough where it can continue into 2022, and that would be helpful. Annualized earnings growth for the 5 years ending 2021 would be 10.5%, well above the very long-term historical trend of 6.5. So that's just saying, we've got some good earnings growth and economic projections. 4 critical factors he reads. In the medium term, a flattening or decline in consensus earning estimates. What does that mean? It just means that if people suddenly think that corporate earnings are going to be flat, or they're going to stay, or they're going to drop, or just stay flatlined, we're going to have problems in the markets. That makes sense. A sustained rise in government bond yields. I talked about that. So if bond yields continue to go up significantly, a sudden shift in Federal Reserve policies. Suddenly, the Fed says we're going to raise rates, and that many Fed participants are starting to say that. By the way, each of these could reach an inflection point within the next, and a shift in investor perceptions regarding inflation. I will say also that I'm starting to hear more concerns about two main things: inflation and taxes. So even the naysayers are now starting to worry about taxes. I've got a fella, and you know who you are if you're on this call, that I've been talking about Roth conversions for probably a decade now. And he finally said to me this year, I want to look at doing those Roth conversions. So is everything I could do not to bite my tongue and say, I told you so, but thankfully he's getting on board, and he's young enough where we can, and he's got enough time before retirement where we can get these things done for him. Okay. In the long term, the biggest challenge for the equity investors is valuation. So it's valuation is what stocks are bought and sold on what we believe they're going to be in the future, not what the value is today, right? I mean, the stock is a value today, but the value of the company. So if suddenly everyone believes that XYZ company is undervalued, then they might buy that stock. If they think it's overvalued, they might sell it. So that he's just talking about investor sentiment about how things are valued. So interesting. This is a really great report. If you want a copy of this report, let me know. I can send it to you. There was also a special report that DeLucia sent out about the Eurozone, and it's really interesting because if you remember, BlackRock this time last year overweighted the European Union and underweighted the U.S. And then it turned out, and that was a tactical move of theirs, and it turned out that the U.S. did much better than the European Union. Europe's still having a hard time crawling out of their economic issues, and they didn't handle COVID as well as what happened in the United States. So there were some interesting thoughts about that. So what's the answer to all these complicated things that are firing at us about the markets and our investments? Well, you should know it. And if we were in class, I'd say it with me. So we have asset allocation, principal protection, and account segmentation. So asset allocation, developing your pie charts, right? Your pie, pieces of your pies. So how your funds should be invested. And then you want to make sure each one of those pieces of pie is the very best that you can find. And you keep it balanced. And there's lots of tools that we have to do that. So first thing is your asset allocation. And most people develop that based on what they need and what their comfort is. So what they need as far as earnings and what they're taking out of their investments, and then what they're comfort in, how much they're willing to lose in the markets. Because, to have growth, you've got to have some risk. Principal protection. Well, principal protection is something that you put money into it, you earn an assumed rate of return. I like to think 3 to 5% in today's environment, but you don't have any risk of principal loss. Well, that helps, especially when you see markets going down, you see even your bonds, your safe bonds falling in value. Well, if you have something that can't go below zero, that's very, very comforting. So you got to determine how much you should have in asset allocation, how much you have principal protection. Account segmentation is a continuation of asset allocation. Now you've got your basic asset allocation, but you peel off accounts, separate accounts to fund specific times in your life. These three pillars or three stool legs, however you want to look at it, really do a lot to build the foundation of your financial plan and your investment strategy. Because like you've heard me say, right out of the Air Force, I lived in San Francisco for 6 or 8 months or so. And I learned while I was out there that the buildings are built in San Francisco to be able to withstand earthquakes. I think the Transamerica building is built on a big ball, and like a big ball bearing. And they know that during an earthquake, there's going to be some damage, but the building, because of the engineering, is not going to crumble. You want to set up your investment strategy the same way. So that's really the answer: asset allocation, principal protection, and account segmentation. And we're, as always, we're defensively optimistic. But defensively is really, really important, because most people who come to us say, 99.9% say, I'm most concerned about not running out of money. And to not run out of money, you've got to protect what you have first and foremost. We need growth too. We certainly need growth. But most people aren't swinging for the fences. And if they are, if that's the type of investor they are, and we can't accommodate it by taking a portion of their investments and giving them the ability to be speculative or more aggressive, then they're not a good fit for us, because I don't want somebody that's going to just be risky all the time. All right, back to inherited IRAs with the few minutes we have left. So an inherited IRA, of course, is money that you're the named beneficiary and you inherit from somebody else. Now, if an estate's named as beneficiary, a trust is named as beneficiary, it makes things a little more difficult. I don't recommend that. Trusts are okay. Naming the estate, I don't recommend. I'm not an attorney, but I've seen too many problems with estates just being named as beneficiary. But you should have named beneficiaries. So I name my wife, she names me, and we make sure that money passes easily, and we know what the rules are. Inherited IRAs, as I told you before, cannot be converted to Roth IRAs, but inherited 401ks can be converted to Roth IRAs if there's a designated beneficiary. So again, make sure that you don't do anything if, God forbid, you inherited an IRA. Call us or call a qualified financial planner, and make sure you go through all the ifs and whats. Well, what if we do this? What if we do that? To just determine the best course. Because listen, if you're, like I said, if you're calling Vanguard, if you're calling Fidelity, if you're calling Merrill Lynch, if you're calling any of those, they're going to want to move, get it done, get you off the phone, get to the next issue. We want to pause and make sure that we do things the right way. New clients are often surprised that we generally don't have a discussion about investment reallocation until our third meeting, which is often 4 to 6 weeks in. Most investment firms want you to do what? They want you to invest the money immediately. That's how they get paid. That's how they want to act. That's how they want to go. I want it to be very deliberate. I want us to have a plan. I want us to make good decisions based on all the facts. And I believe that's the way we operate. And that's the way that you should be with your funds, especially when you're inheriting money. So that's an inherited IRA. Now, again, if you're a spouse, you can move that into your name as a spouse. You can keep it as an inherited IRA and transfer it at any time. And there's pros and cons of either way. I talked about the changes to the Secure Act. The Secure Act made changes for the rules of beneficiaries who inherit retirement accounts. It used to be that if you inherited an IRA, you set up a beneficiary designated IRA or inherited an IRA, and you could take a stretch over your lifetime, which simply meant you're able to just take a bit, depending on the IRS tables. You can find those IRS tables on our website. But based on those IRS tables, you would take a certain amount every year, your required minimum distribution to take out of there. And if you were young enough, you could prolong those distributions for decades. Now the IRS in 2019 said, no way, not anymore. We want our money, right? IRS wants their money as soon as possible. They made it 10 years. Unless you're an eligible designated beneficiary, and we've talked about who those are, and that's surviving spouses, minor children of the account owner, disabled individuals, chronically ill, and beneficiaries not more than 10 years younger than the IRA owner. So there's a lot of pieces to that. You be careful that you don't take something that's protected from a tax standpoint and make it something that now you have to pay 100% tax on. What if you had, like that attorney who contacted me and said she moved a few $1 million into an estate account, most of it was IRAs. Well, if she had 3 beneficiaries, right, or 3 beneficiaries of the estate out of the will, well, really, there's going to be a lot of tax due on that, right? And geez, I assume that would be come to the estate. That's a good question. I'm not sure if the estate would pay that tax. I guess the individual would. Anyway, but unnecessarily, right? Each individual, they could have rolled that into an inherited IRA account, $1 million a piece if that were the case. and done with what they wanted to at that point. This was before the Secure Act, so it was before the change in the tax law. So they could have taken those distributions over their life expectancy and then passed it on to their next, their next folks, um, their beneficiaries. But in this case, it all had to be distributed in that 1 year, and that's really unfair. Somebody might have wanted all that money in 1 year, but somebody may not have. That's a lot of tax, and it affects other things. If they're of Medicare age, suddenly they've got income related monthly adjustment amount that has to be paid. They may not get a child tax credit. There's just all kinds of things that can happen. Of course, if you have children, you can conduct. So two different people. Right? There is a question. About this is somehow a slot question ended up on the bottom of my notes. This is a good one actually. This is about inheriting a Roth IRA under the Secure Act. So the question is, does the Secure Act affect inheritors of a Roth IRA account? If so, in what way and why? Since it's not a pre-tax account, right? So the Roth is after-tax money. You've already paid money on that. You don't pay tax on it when it's withdrawn, as long as you met all the requirements, and neither do your heirs. So the answer was, and this fellow's name is Vikram, the answer was yes, the Secure Act does affect inherited Roth IRAs for those inherited in 2020 or later. Any Roth IRAs inherited prior to 2020 fall under the old rules. Obviously, that doesn't apply to us. Under the Secure Act, only eligible designated beneficiaries, that is spouses, minor children of the account owner, disabled individuals, chronically ill individuals, and beneficiaries not more than 10 years younger than the deceased IRA owner can stretch RMD payments over their own life expectancy. The Secure Act requires non-eligible designated beneficiaries to empty the inherited Roth IRA account by the end of the 10th year after the year of the death. Why does the Secure Act speed up RMD payments for a Roth IRA? Well, probably they're saying so that those funds get back into circulation, because while in the Roth, they're protected. Just like prior to the Secure Act, as a Roth IRA owner, we don't have to take required minimum distributions. That's still true. But it used to be prior to the Secure Act that your heirs did have to take required minimum distributions. But now, under the Secure Act, that Roth IRA has to be depleted within 10 years. The IRS wants their tax money. They've already received the money on that Roth IRA. And if you pass away and pass it to a non-eligible designated beneficiary, then that money is coming back into circulation to be taxed again after 10 years. So, that same dollar gets taxed over and over and over and over again. It's just, we want to do what we can to insulate it for as long as we can. And the Roth IRA, and in my opinion, cash value life insurance, are the two vehicles that really allow that to happen. Okay. I'm going to take a breath there. We have no questions. And if there are no questions, I'm going to end there, and I'm going to wish you all a great Tuesday. And I want to thank you for being with me again. I appreciate your time. I appreciate many of you come back week after week after week, and I really appreciate that. Join us next Tuesday again. Look out for the upcoming special webinars. If you need to schedule time with me, my calendar will populate as you log off, and I hope to talk to you all soon. Take care and have a great day. Bye-bye. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.